Welcome back, everyone, to today's Explainer. Look, we're talking about the absolute engine behind passive wealth generation today. Now, if you're already plugged into investing, you obviously know the term compound interest. But today, we're going to strip it right down to the studs. We'll look at the pure math and remind ourselves exactly why our human brains almost always underestimate this absolutely incredible financial mechanism.
Okay, let's dive into this. Making money make money. It kind of sounds like a catchy late-night infomercial slogan, right? But how does capital actually replicate itself? Because when we think about building wealth, we almost always picture active labor, working harder, taking on more side hustles, or just clocking more hours. But the true engine of wealth, it doesn't require you to clock in at all. It requires your capital to do the heavy lifting for you. And to understand exactly how that happens, well, we need to define the exact mechanism powering this geometric growth.
That mechanism, of course, is compound interest. Now, the formal textbook definition is the interest an investor earns on their original principal plus all the accumulated interest over time. But honestly, the only three words you really need to internalize are right there at the bottom. Interest on interest. It's just so much easier to think of it this way. You aren't just earning a return on the cash you originally deposited, you're actually earning a return on the returns you've already generated. It's literally a self-feeding loop.
But to truly appreciate the power of that loop, we kind of need a baseline to compare it to. So let's put simple interest directly up against compound interest. Simple interest is exactly what it sounds like. It's totally linear. It only ever applies to your original principal, meaning it never evolves, and it definitely never accelerates. So by using simple interest as our sort of control group, we're going to be able to isolate exactly where the compounding math really takes over.
Let's put this into a concrete 3-year financial experiment. Imagine you walk into a bank, right, and you deposit exactly $10,000 into a high-yield savings account offering a pretty solid 5% rate. And you leave that money completely untouched for 36 months. No withdrawals, no extra deposits, nothing. Let's run this exact scenario through both the simple interest model and the compound interest model to really see where they diverge.
Starting with our control group, let's look at the simple interest breakdown. Remember, simple interest only cares about your original 10 grand. So year 1, you get 5%, which is $500. Year 2, exact same math, another $500. Year 3, yep, another $500. Add it all up, and after 3 years, you've earned exactly $1,500. It's entirely linear, it's entirely predictable, and, well, it's fundamentally limited. I mean, it works, but it's really not working hard for you.
Now, what's really interesting about this slide is where the math fundamentally shifts by compounding annually. Let's walk through this one together. Year 1 looks identical. You earn your $500. But year 2, that's the inflection point. Your starting balance is now $10,500, so your 5% yield is calculated on that new, slightly larger number, which yields $525. By year 3, you're earning 5% on $11,025, giving you over $551. Do you notice how that interest column actually accelerates? The snowball is officially rolling down the hill, gathering mass.
And that brings us to the final results of our 3-year head-to-head experiment. Over on the left, our simple interest sits exactly where we left it, at a flat $1,500. But the compound interest total comes in at $1,576.25. Remember, this is the exact same initial deposit, the exact same 5% rate, and the exact same timeline. The mathematical structure of the account alone is what generated that extra wealth.
So the crucial point is that extra $76.25. Now look, I know you're thinking right now, $76, wow, that's not exactly going to buy me a private island. But you have to look past that small dollar amount for a second and just see the principle at play here. You did zero extra work for that money. None. The mathematical structure literally willed it into existence in just 36 months. It's purely the result of your interest earning its own interest.
Which brings us to the actual secret ingredient that makes this whole concept explode, and that is time. As you can see from the quote, the effect of compounding becomes especially powerful over longer time periods as the amount of earned interest becomes larger and larger. What we just saw with that $76, that was literally just the very first rotation of the snowball. As decades pass, the principal swells, the interest payments swell along with it, and the curve of your wealth generation bends sharply upward. Time is the asymmetric multiplier that turns a tiny difference into an absolutely massive financial gap.
And that actually leads me to the most critical question of this entire explainer. Are you giving your money enough time to compound?
because we've seen this interest-on-interest dynamic in action now, and we know for a fact that the results are entirely dependent on how early you actually start the clock. Every single day you wait is another rotation of that snowball you're just totally missing out on. So, take a hard look at your financial timeline today and let that snowball start rolling. Thank you so much for joining me. Keep structured
Interest on top of that. So you aren't just earning a return on the cash you put in, your returns are actively out there generating their own returns. It's literally interest on interest.
Section 1, setting the stage. We're going to run a little $10,000 thought experiment.
Imagine you've just opened a brand new high-interest savings account and you're dropping in a starting principal deposit of exactly $10,000.
Now, we need some ground rules for our game. Let's say we apply a standard annual interest rate of 5%, and we're going to track this over a neat, short 3-year timeline.
Section 2, the baseline. Before we get to the magic, let's quickly look at how simple interest works.
So with simple interest, you earn interest on your original principal only. That's it. The foundational math here is completely static, meaning your payout is never going to scale up.
Now, what's really interesting about this slide is just how totally flat the math is. Year 1 yields $500. Year 2, another $500. Year 3, you guessed it, exactly the same. The calculation literally doesn't change.
So, at the end of those 3 years, your total interest earned sits right at $1,500. It's a reliable, perfectly fine, static baseline.
But here's Section 3, the upgrade. Enter compound interest.
Let's walk through those exact same 3 years. But watch how the principal grows this time. Year 1 is an identical $500. But in year 2, you earn 5% on $10,500, yielding a larger payout of $525. By year 3, your principal is up to $11,025, pushing your payout to $551.25. The payout is physically accelerating.
Compounding annually over those exact same 36 months, you've earned a grand total of $1,576.25.
Which brings us to Section 4, the showdown. Simple versus compound. If we compare these strategies side by side, the mathematical advantage becomes crystal clear. Simple interest leaves you with an extra $1,500. But the compound interest strategy, that generates $1,576.25 over the same period.
And this brilliantly illustrates exactly how that mathematical advantage pushes your wealth just a bit higher, even over a relatively short window of time. That gap is exactly $76.25. Now, you didn't work any extra hours for it, and you didn't invest a single extra penny. It's capital created entirely by the mechanics of the account. It is the literal definition of your money working for you.
Section 5, the real magic. The power of time. Let's look at how this projects far into the future.
So the crucial point is this. The effect of compounding becomes especially powerful over longer time periods as the amount of earned interest becomes larger and larger. Think of it like a snowball. As its surface area expands, it packs on more and more snow with every single rotation until, suddenly, it's an absolute avalanche.
So here's a thought to leave you with. If just 3 short years yields an extra $76, essentially out of thin air, what could 30 years do for your savings? There are decades of interest piling onto interest out there, just waiting to be leveraged. Thanks for joining me for this explainer, and keep exploring.